Okay, well, welcome back, everybody. Ladies and gentlemen, today we deal with our final topic of this subject. So you have made it. By the end of today, you will hopefully, have a good understanding of the whole audit process from beginning all the way to the very end. And on that note, that is what we are talking about today. Today, we will go through the completion or the conclusion stage of the audit and all of the activities and tasks that are involved in that final stage. And remember, at the very end of the audit, the ultimate output is our audit opinion. And the audit opinion sits in the audit report. So we did discuss that at the very beginning of the semester, but we're going to go back through that at the end of today's class. So let's get into it. Here we go. All right. Now, the activities that are included in that final stage include things such as we review for contingent liability. So we'll go through that first. We then go through and review what we call subsequent events. Now, ladies and gentlemen, that is the topic, out of all the topics today, that's the topic where students often do struggle sometimes. So I will try to be as clear as I possibly can in relation to it. We also we accumulate all the evidence and we evaluate all the results from the testing that we have conducted. We communicate to the client. We communicate with management. We communicate with the audit committee that is in the client. We also communicate with the board of directors. So that communication happens, and ladies and gentlemen, the final result, the absolute conclusion of the audit ends with the audit report and the audit opinion that sits within that report. So let's go through each of these. The first activity I want to go through with you is reviewing for contingent liabilities. Now, the first question is, well, what's a contingent liability? A contingent liability is defined as a potential future obligation to an outside party for an unknown amount resulting from activities that have already taken place but are conditional on some future event. Ladies and gentlemen, your key terms here, it's a potential future obligation and it's conditional on some future event. The best example I can give you of this is a lawsuit. A lawsuit is a really good example of a contingent liability. Why? Because a lawsuit, the result of a lawsuit, can result in a potential future obligation, but it's conditional on some future event. What's the future event? A verdict. So if the verdict is not in the favour of the business, it can result in the business having to pay damages, which is a liability, right? But that's not an actual obligation until the verdict comes through. So up until that conditional future event, which is the verdict, it remains what we call a contingent liability. Ladies and gentlemen, whenever I teach this to Accounting A and Accounting B, you know what I call it? I call it a maybe liability. A contingent liability is a maybe liability. The reason I refer to it in that way is because it's a maybe. It's not a real liability yet. It depends on a particular thing to happen in the future to give rise to this obligation. So until that point, it's a maybe. Now, before I go anywhere, ladies and gentlemen, let me ask you a question. And I want you to just raise your hand or say yes or no to this. Actually, just say yes or no. Contingent liabilities, are they included in the financial statements, yes or no? No. No, financial, so is it included in the balance sheet, yes or no? Use your words. What is it? Is it included? But it's a liability. Ladies and gentlemen, do not get fooled by this term. It's not a liability, that's the whole point. It's a maybe liability. What does that mean? There is no obligation yet. As a result, you cannot and do not include it in the balance sheet. Ladies and gentlemen, contingent liabilities are disclosed in the notes. They're disclosed in the notes to the financial statements, which are included in the financial report. Please be very careful about that. It's not a number we include in the statements. It's not in the balance sheet. Do not let that second term of liabilities sway your judgment, okay? It's a contingent liability, a maybe liability, which means we don't include it in the balance sheet, we disclose it in the notes. Okay, that's the extra explanatory material that's included in the report. Now, so what are some other examples of situations that give rise to a contingent liability? We discussed legal action. So remember, up until a verdict comes through, we don't know if the business has to pay or not, so it's contingent upon that verdict. Income tax disputes with the ATO. If there's a situation where the ATO is claiming that the business owes them more tax, they haven't paid enough, until that verdict comes through, it's a contingent liability. If the decision is made that, yes, the business does owe more tax, then it becomes a tax payable. Okay, but up until that, it's disclosed in the notes until that verdict comes through. So essentially, it's all residing on that same notion. It's a maybe liability. It depends, it's conditional on some future event, okay, whether it's a verdict or a decision being made. The only other one I want to discuss here is guarantees. Now, if you haven't heard this term before, the best way of thinking about it is in relation to a bank loan. Now, in particular, think of a relationship between a parent company and a subsidiary. If the subsidiary wants to go and get a bank loan, the bank may turn around and say, well, if you can't pay, who's going to be your guarantor? Now, a guarantor is an entity or a person that's going to step in and settle your liability if you can't do it. So in this case, an example would be if a parent company agrees to be the guarantor of the subsidiary when it comes to a loan. What does that mean? It means if the subsidiary is for some reason not able to meet the loan repayments and to actually settle the loan, the parent agrees to step in on their behalf and pay to pay the loan. Now, here's the thing. The contingent liability would sit on which financial statement? The subsidiary or the parent? The parent. Because it's if, the conditional event is if the subsidiary can't pay, the parent will. So it's a conditional liability for the parent. Does that make sense? If the subsidiary can't pay, it becomes a liability of the parent company. So these are just some examples of situations or instances that give rise to a potential contingent liability. Now, we as the auditors, we look at this. Why? Because, ladies and gentlemen, we've talked about this before. As auditors, we're not just concerned with the numbers. We're concerned with the words as well. Now, what are the words? The disclosures. So we're not just giving an opinion on whether the numbers are correct, we're also giving an opinion on whether the disclosures, the extra information in the report, that is also true and fair. And that is part of that. So that's why that's one of the first things that we do in the completion stage. Now, what are some procedures that we actually undertake to find contingent liabilities? First one, we always start off, we ask questions of management. We inquire with management as to, are there any contingent liabilities? Are there any instances that we need to be made aware of? We also look at ATO correspondence. Now, this will help us determine if there is indeed a tax dispute regarding the tax expense or the tax payable. We look at contracts and loan agreements. As we just said, a guarantee or guarantor situation could give rise to a contingent liability as well. This is the key one. I'm going to do this one in green. This is a really important one. And this is actually a procedure we do for quite a lot of things. We review board minutes. Now, if you don't know what these are, we have discussed them before, but basically what meeting minutes are, every time that senior management or the board of an organisation have a meeting, they record what is said in that meeting. That is what we call board minutes. So it's basically a document that sets out what was discussed in the meeting and any decisions that were made as a result of that meeting. Why is this so important for us to review? Because, ladies and gentlemen, if something significant has happened, they're going to talk about it. If they talk about it in the meeting, we're going to be able to read it in the meeting minutes. So if they do engage in getting a new loan, they would talk about it in the minutes, so we would see it there. Things like that. If there's an issue with the tax office, they would discuss it in the meeting, we would see it in the minutes. So reviewing those documents is actually a really important task that we do, and I've actually had to do that myself. You sit and you read every single one to see if there's anything significant that would result in them having to disclose a contingent liability. That's a really, really important one. Now, another thing that we do is we analyse their legal expense account. Now, this is interesting. We look at their legal expenses. Let me ask you a question. What would be a reason why a business's legal expenses would go up? What could be a reason for that? Why would the, yep. Extended case. Sorry? Extended case. Yes, extending a case. So there's a case that they're working on. What else? there is a case in the first place, right? You didn't know about it, but the fact that their legal expenses are going up means that they're recruiting their lawyers for something. Why? What is the situation? So we actually look at that account to see if there is a movement, because that would also relate to there's some litigation or some legal problem that they're trying to deal with. So that also can give us an indication of a potential contingent liability. Now, one more thing that we do, we actually talk to the lawyers. So what we do, and I'll do this one in yellow, this is what we call a legal representation letter. Now, what happens here is we communicate with the client's legal counsel through this letter, legal representation letter. And essentially what's happening here is that we're asking them, dear lawyers, are there any cases or is there any litigation currently happening with this client? If so, what are the details of the case? What's the likely outcome of the case? What's the financial impact if there is a likely outcome? Okay, we want to get this information because, again, ultimately it's going to help us determine if there are contingent liabilities that the business needs to disclose. Ladies and gentlemen, you have to remember one thing. A misstatement is not just a number being wrong. A misstatement is also if they were supposed to include something as a disclosure and they didn't. Okay, so this is a really, really important area for us to look into. Now, that was the first task. Here's the second. Subsequent events. Ladies and gentlemen, as I mentioned earlier, this is one of the topics that students do sometimes struggle with, so I will try to be as clear as I possibly can. But the note that I'd like to make here is this. There are certain things that as we go through these slides and the explanations that I provide might be slightly different to what you read in your textbook. So please be mindful, I want you every time, you should always be following the guidelines from the auditing and accounting standards. In this case, ASA 560 is the auditing standard dealing with subsequent events, and AASB 110 is the accounting standard. My advice, AASB 110, get it, download it, print it off. It's a very easy read. It's only a few pages long in terms of actual content, but please use that as your reference point. The slides, mainly, I've structured them in accordance to AASB 110. So you'll see what I mean as we go through it. So the topic is subsequent events. First question, well, what's a subsequent event? Ladies and gentlemen, the term subsequent literally means after. We're talking about events that happened after. After what? The end of the financial year. Now, one of the most, probably the most important piece of advice I will give you at this point, particularly in relation to this topic, ladies and gentlemen, when you get a subsequent event question, do a timeline. It will help you immensely. Now, what's a timeline? Here we go. What you will see is that from here to here, that was the financial year. Okay, so let's just say, for example, the 30th of June 2016 to the 1st of July 2016 to the 30th of June 2017. That becomes our financial year. Now, the end of that marks the end of the financial year, so end of financial year. Now, one thing to note just very quickly, guys, just another term that we may use for end of financial year is balance date. So if you ever read or see the term balance date, that means the end of the financial year. Now, before I go anywhere, you need to be very aware of this. Most students always think that every company, the end of their financial year is the 30th of June. That's not true. We have companies that end on the 31st of March. We have companies that end on the 30th of June. There's the end of September or there's the end of December as well. So just be mindful. Now, when I give you questions on this, I will give you the dates. So you will be able to actually create a timeline such as this one. So for example, we've got the 30th of June as the end of the financial year. We then continue doing our audit work until the day that we sign the audit report, ladies and gentlemen. That is the day we sign the audit report. Now, for example's sake, let's say that happens on the 10th of August. So we continue doing all our testing up until the day we sign our audit report. In this case, it's the 10th of August. A few days after that, so say on the 12th of August, the financial report, including our signed audit report, is released. Okay? That's essentially the timeline of what's happening. So the financial year happens, we get to the end, we continue performing our testing up until the day we sign our audit report, And then a few days later, the financial report is released to the public. Now, why did I do this? Because, ladies and gentlemen, a subsequent event is any event that happens after the end of the financial year. So after, in this case, the 30th of June. Any event that takes place after the 30th of June, in this case, would be called a subsequent event. Now, what do you need to know? You need to know the different types of subsequent events. You need to know the responsibilities we have as auditors in relation to subsequent events, and you need to know what we do in relation to the subsequent events we find, okay? So I'm going to go through those in the next few slides. Now, in particular, why is the timeline important? Ladies and gentlemen, the responsibilities that the auditor has in relation to subsequent events actually is dependent on when they discovered the subsequent event. So did they discover it here? Did they discover it here, or did they discover it here? The responsibilities are different depending on the time that we discovered the subsequent event. So let me go through that in the next slide. So I've provided you with another timeline down here. Please do note these are just example dates, okay? Not every question will have a financial year ending 30th of June, the audit report being signed on the 12th, and the financials being released a few days later. I will give you that information in a question, so this is just an example. But what I want to highlight to you all is this: the responsibilities of the auditor changes depending on the time period. Now, what do I want to focus on? Period 1. Period 1 is the time between the end of the financial year, which is this, and the date that the audit report is signed. That's the first period. So in this case, from the 30th of June to the 12th of August, okay? Ladies and gentlemen, this is really important. What I want to say before anything else is this: up until the day we sign the audit report, we're working. Up until the day we sign, up until the 12th of August on this particular occasion, we are doing audit testing, we are doing audit procedures, we are evaluating our results, up until the day we sign. Now take that and bring it into subsequent events. Ladies and gentlemen, during this period, up until the day that we sign the audit report, we, as the auditor, we have an active responsibility to go looking for and investigating subsequent events. Write that down. Up until this day, up until the day that we sign the audit report, we have a responsibility to actively look for and actively investigate all subsequent events up until that day, okay? Now, just before, if anyone is curious of this, well, why would we care? Because here's the thing. Events that happen after the end of the financial year, some of them may impact or may relate to something that happened in the year. And that requires us to go back and make some adjustments. So I'll take you through that in just a moment, but I want to highlight that this is important because it can relate back to the year that has passed. So again, to recap, up until the day that we sign, we have a responsibility to actively search for and actively investigate all subsequent events. After the day that we sign, so in this case, after the 12th of August, so anything after that, our responsibility comes down. Now, what does that mean? After the day that we sign, the responsibility that we have is to only investigate the subsequent events, here we go, that come to our attention. So we don't go looking for them, we only investigate subsequent events that come to our attention after we've signed. Up until we sign, we need to look for it. After we sign, it's just those that come to our attention. Now, you might be thinking, well, how do they come to your attention? You read newspaper articles, you look at company announcements, things like that, but you don't go looking for them. Yes?
I keep signing the audit report. Are you officially signed off, like you're not being employed by them anymore?
Kind of, but if something does come to your attention, you still do have that obligation to go back and see if something needs to happen. Yeah, so you're not completely saying, I'm done, but it's your level of responsibility and your active involvement, you take a step back. And that's why the term is what things come to your attention, okay? So that's important. So responsibility is quite intense up until the day we sign. After that, responsibility goes down a level and you only look for, you only investigate events that come to your attention. Now hold that thought, because we have two different types of subsequent events. Now, it's really important for you to be able to distinguish which type of subsequent event you are dealing with, because depending on the type, the implication on what we need to do is different. So here we go. The first type, type 1, It's called adjusting events. Okay, now that's an indicator for you, but let me explain to you how do you know that it's type 1 event? Ladies and gentlemen, a type 1 subsequent event, an adjusting event, is any event that provides additional evidence with respect to conditions that existed at year end. So let me rephrase this one. A type 1 subsequent event, I should call it an adjusting event, is anything, listen very carefully, it's anything that happens after the end of the financial year, but it relates back to something that happened in the year and something that existed at year end. Now let me give you an example of this. We find out, and this is an example I've provided on your slides, the first one, we find out, you know what, let's do some dates. It's going to make more sense to you. Let's do a timeline. And this is the importance of timelines, by the way. So say this is the end of the year, 30th of June, and we're going to sign the audit report on, we'll keep it consistent, the 12th of August. Now we find out on the 15th of July, that a really big customer of the client has gone bankrupt. Now that customer owed the business, on the 30th of June, they owed the business $100,000. So in the financial statements, under the balance sheets, under accounts receivable, that customer was listed as owing $100,000. Now here's my question to you. If on the 15th of July, we find out that this customer went bankrupt, is the business going to recover this $100,000, yes or no? No. Ladies and gentlemen, this is something that happened after the end of the financial year, but it relates back to something that existed at the end of the year, which in this case was the accounts receivable. Now, add one level to that. Guys, it's giving us more information or additional evidence on something that existed and was recorded on the 30th of June. So now that we know that the particular customer has gone bankrupt, what we need to do is we need to go back, and here's your key, you need to adjust. You need to adjust your accounts receivable to reflect the fact that they're not getting this money. A subsequent event that happens after the end of the financial year can result in you having to go back and adjust because now you have more information on that item. So with accounts receivable, remember, the biggest risk with accounts receivable is you're not going to get the money back. Now, on the 15th of July, we've actually got confirmation they're not going to get the money back. As a result, you have to go back and you need to adjust. What do you adjust? Here's the thing. You now know the business is not going to recover that $100,000. So what do they need to adjust? Ladies and gentlemen, write this down. The allowance for bad debt account. They need to put the $100,000 into allowance for bad debt or provision for doubtful debt, whatever the terminology is you're familiar with. They need to make this adjustment. They need to ensure that it's reflecting the fact that they're not going to get this money. In addition to that, in the note to accounts receivable, they might include that as a disclosure also, saying that we had to make this adjustment because this customer has gone bankrupt, right? Now, this is the most important one because it requires you to go back and actually change the numbers. The key notion is this: even though it's something that happened after the end of the year, it relates back to something that was uncertain at year end. What was uncertain? Are they going to pay me back or not? Now you know it's a no. So you have to go back and make sure the numbers reflect that. Okay? Let's do another example. Settlement of a litigation. So there's a lawsuit. There's a lawsuit that's been happening for a couple of years, or it's been happening just this year. Now we find out, let's keep the dates the same. We find out on the 15th of July that the court case was settled. But it was settled at a number that's different to what the company originally thought. So what needs to happen is, because this related to the court case that was happening during the year, we need to go back and again adjust. Now, how do you adjust? It depends on the case itself, but we need to make sure that there was a contingent liability in relation to it. If they already know exactly what the amount is, it might become a liability instead of a contingent liability because now they know. The key overriding notion here, guys, is even though an event happens after, it can come back and influence or relate to something that happened during the year and existed at year end. If that's the case, you have to go back and adjust. You adjust the numbers, okay? And you might need to make a disclosure as well, given what's happened. Now, this is important because this is a distinguishing feature to the next one. Before I go to actually, let me just say one thing. The name kind of helps you. Type 1 is an adjusting event. So what do? You adjust. You need to go back and adjust. Here's the thing you need to be very mindful of. You only do it if it's material, if it's significant, okay? Remember, it's only significant events that cause us to go back and action something. So just be mindful of that. Now remember, this was type 1. So something that happened after but relates back to something that happened within the year. The second type is what we call a non-adjusting event. So as the name suggests, you're not going to be adjusting. But what is this one? Ladies and gentlemen, this type of subsequent event refers to events that happen after the end of the financial year, but they don't relate back to something in the year. The best example is if there is an unexpected disaster or fire or some form of natural disaster that damages their inventory or completely destroys some assets that they have. Now, those types of events, by the way, I just described this one, that type of event you can't link back because nothing happened during the year. This disaster or this flood or whatever, or this fire, whatever it is, it happened after the end of the year. So the definition we use for type 2 non-adjusting events is that it's an event that indicates conditions that arose after. It's conditions that arose after the end of the financial year. What does that mean? It didn't exist at year end. The fire didn't happen at year end. The fire happened afterwards. So it's providing us information with an event, with a condition that arose after the end of the financial year. Now, because it doesn't relate back, we don't adjust. We don't go back, we don't change the numbers. But what do? Again, if it's significant, remember, significant means material. If it's significant or material, we disclose it in the notes, okay? So if it's an adjusting event, you go back, you make your adjustments in the numbers, and you make a disclosure if it's required. But with non-adjusting events, you don't go back and change numbers. Rather, you will disclose that extra information because it's deemed to be important. Now, what are some things that could be important? Well, if there is a fire or there's some disaster that destroys a lot of assets, that's pretty important. What else is important? If the business is going to sell, if the business does sell shares or issue bonds after the end of the financial year, that's important too. What else? If they sell a part of the business, so the company sells one of their subsidiaries, that's significant. If they merge with another company or acquire another company, that's significant as well. So these are examples of type 2 non-adjusting events. They happen after the year end, but don't relate back. So you don't adjust, but rather you disclose in the notes to the financial statements. Again, remember, a misstatement is not just a number being wrong. It's also when they are supposed to disclose something and they don't. So if we discover this and they haven't disclosed it, that's a misstatement as well. So just be mindful of that. So what are some procedures we carry out in order to find subsequent events? We ask management. We ask them, have there been any subsequent events that we need to be mindful of? We look at the legal representation letter, just like last time. Have there been any lawsuits or any developments in the litigation cases that we need to adjust or disclose? We look at internal statements and records. For example, loan contracts. Have they entered into a new loan? Is it significant? Guys, why is loans really important? Because a loan is not just an extra liability. A loan, particularly in relation to a business, comes with debt covenants. We've talked about debt covenants before. It's the terms and conditions associated with the loan. Now, they're really important because remember, if they breach a debt covenant, they have to pay back the whole loan. And that will impact on their ability to keep on operating, which is a going concern issue, which we'll discuss later. So it's important to look at that. Company announcements. If they're going to sell shares, there's going to be an announcement about it. So there are these particular things that we can do to see if there have been subsequent events. Guys, meeting minutes. If something significant has happened after the end of the year, They would have discussed it in a meeting. Therefore, it would have been recorded in the meeting minutes. So we can get that by reading those documents. Something else that we do is we obtain what's called a management representation letter. Now, you haven't heard me use this term before. What you have heard from me is a management letter, which is different. So management representation letter is described in the next slide. First of all, the standard relating to this particular letter is ASA 580. Now, the document is called a management representation letter. This is basically when management writes to the auditor. And what they say is, we promise that we have been truthful in all our communications with you. We've given you access to all the information that you needed. We have told you everything that we know. We haven't held anything back. Essentially, we've been upfront, we've been honest, right? So that's all the things. It's completed information. We've told you everything about, we've disclosed everything. We've told you about our risks and uncertainties. That was there. We've told you about any subsequent events that we knew about. But here's the key one that I want to focus on. In this letter, they acknowledge one more time that it is management's responsibility to make sure the financial report is true and fair. So they acknowledge it, that it's on them. Because remember, even if we find something and we say, guys, this is a misstatement, you need to adjust, we can't force them to make the adjustment. It's ultimately their decision. So in this letter, they acknowledge once again that yes, we're the ones ultimately responsible for the financial report. And that's really important because that kind of covers us again as well. It's not our responsibility to make sure the numbers are right, it's theirs. We're just coming in and checking the information. So just be mindful of that. Now, as I said, a management representation letter is different to a management letter, which we'll talk about later. The key thing is this, guys, management representation letter is management to auditor. A management letter is from auditor to management, okay? So just be mindful of that. Now, what do we do? So at the end of the audit, when we've done all our testing and we've noted all the adjustments and they've made the adjustments, we actually perform analytical procedures again. Now, if you recall, we performed analytical procedures at the beginning of the audit and in the middle of the audit. And if you recall, the main reason why we did that is to identify unusual trends, unusual relationships, things like that. Now, based on that, we would have gone through, done some testing, identified any issues and corrected them. So why do we do them again? We want to see whether the unusual relationships or the unusual trends are still there. Let me give you a really quick example of this. If we originally, when we did, actually I did this in purple. When we originally did analytical procedures for sales and COGS, so say we found out that sales have gone up by 30% and COGS had also, sorry, that's terrible. And we find out that COGS had also gone up, but only by 5%, and I've given you this example before, that to us doesn't look right. Because as we know, sales and COGS are actually related accounts. Every time you make a sale, COGS is also impacted. So they do both go up, but they should be going up in the same proportion. So to have one side up by 30% and the other only up by 5%, that's a bit strange. Now, say we thought we found this. We then investigated, we did more testing, and we found out that they had overstated or duplicated sales, and they hadn't included all the COGS transactions. So what happens is they make those corrections, we come back at the end of the audit and we redo this particular task. We redo this analytical procedure, and we find that sales has now, because of the new numbers, they've gone up by 15% rather than the 30%, and COGS has improved by 15% as well. Now it's consistent. Now we know that the issues that we identified have been corrected and the numbers are now accurate, essentially. So what we do with analytical procedures is essentially, did we fix it? If you want to think about it that way, okay? Have the unusual trends, have they gone away once the issue has been corrected? So that's one thing. Now the other, and this is the one I really want to focus on with you, is going concern assumption. Going concern assumption is really, really important. Guys, ASA 570 is your standard here. Now let me ask you all a question, and just a yes or no answer and get involved. Going concern. Is going concern a good thing or a bad thing? Is it a good or bad? What do you think? Let's do that again. Good or bad? One more time. Good or bad? I'm looking at you. What is it? Michael? No, there's not Michael. Good. Ladies and gentlemen, look at that first point. Going concern is an assumption. What's the assumption? The assumption is that the business will keep on going. A lot of the times people get this mixed up because they see the word concern, they think it's a bad thing. It's not. Going concern assumption is an assumption that the business will keep on operating into the future. What does that technically mean? And I do urge you all to underline this because this is important. How do we know a business is going to keep on operating into the future? They can pay their debts as and when they fall due. So if their liabilities became payable right now, could they pay them? Right? That's the technical definition. Essentially, in layman's terms, going concern is, will the business continue operating into the future? Now, why is this important? Because this is actually a critical component of the audit. Why? Because if you didn't know this, I urge you to write this down. You know what? I'll do a new page for you here. So remember, this is very important. I'll do a new page and I'll explain it that way. Okay, so with going concern, as we said, it's an assumption that the business will keep on operating into the future. Now, the reason why this is a really important assessment to make is this. The basis upon which a financial report is prepared for most businesses is a basis called going concern basis. Now, what does that mean? It basically means that the rules and the standards that they have followed in preparing their financial report, which includes their statements and their notes, has followed what we call going concern basis. It's followed this basis or this template that is premised on the assumption that the business will keep on operating into the future. Now, what's my point? My point is this. If the business is not a going concern, if the business is not actually going to be able to keep on operating into the future, if it's really improbable that that's going to happen, they cannot prepare their financials under going concern basis. Rather, what they have to do is they have to prepare it under liquidation basis. It's a different template or different rules they need to follow. Now, this is important because here's the thing. If the business is a going concern, then this is fine. If the business is not a going concern, if they're going to go bankrupt very soon, or if they're going to shut down, and we know that they're going to shut down, they cannot prepare their financial report under this basis. They have to prepare it under this one. Now, here's your link. If a business is not a going concern, which means they have to prepare their financials under liquidation basis, but they don't, they continue to do it under going concern, ladies and gentlemen, adverse opinion. Write that down. The audit opinion becomes what we call an adverse opinion, which is the really bad one. Okay? So it's really important for us to know, are they a going concern or are they not? Because if they're not, the basis, the rules, the standards that apply to them are different. So the preparation of their financial report is on a completely different basis. And if they don't follow that, then the whole report is wrong, which leads to, as I said, an adverse opinion. Okay, if the basis is wrong. Now that's really extreme. It's really extreme. So let me step back and tell you two other things that can happen. If we believe that the business is indeed a going concern, right? We think that they're fine. There's no issues and everything else in the financial report is true and fair. In that situation, we give them an unqualified opinion. That's the good one. And we'll be going through this in more detail later, but that's the good one, okay? However, there can be situations, and there often are in some businesses, situations where there are what we call going concern issues. Going concern issues. Now, what's a going concern issue? A going concern issue is not necessarily they're going to go bankrupt, but rather it relates to issues or conditions that have come up that makes you think, there's a bit of uncertainty about whether the business is okay. It's not enough for it to be liquidation basis, but there are some issues. Now you might be thinking, okay, like what? Guys, if a business is making a net profit every single year, that's a going concern issue because they can't continue making a net loss and keep operating. A more important one is if they're having cash flow problems. Now, a lot of people don't realize this. Businesses don't go bankrupt because they're not making profit. Businesses go bankrupt because they don't have cash. And that's why if you're ever and just heads up, if you're ever analyzing like an investment opportunity when it comes to a business, don't look at their profit because profit can be manipulated. Look at their cash flow. Cash flow is a much stronger representation of how successful, how well-performing a business is. Now, coming back to this, those are just some examples of going concern issues. All right? They're basically, it's things that make you feel like there's a bit of uncertainty as to whether the business can keep on going. It's not enough for it to be a big, no, it's not going to be going concern, but there are just some issues that make you uncertain about it. Now, when that happens, coming back to the point, when that happens, under ASA 570, it states that management must disclose the issues. Management must disclose the issue. So within the notes to the financial report, which they can still prepare under going concern basis, but in the notes they have to tell the users, hey, by the way, we're okay, but there are some issues. Here are the issues. So they have to disclose those issues. Now, here's the point, coming back to audit. If management do disclose the issues, we can still conclude true and fair. We can still conclude that we can give an unqualified opinion. Why? Because remember, we are not assessing whether the business is good or bad. We're assessing whether the financial report is true and fair. So if they're having going concern issues and they've disclosed them, that's still true and fair. So in that situation, we're still able to give an unqualified opinion if there's nothing else that's wrong. However, because going concern is so important, we add something to our unqualified opinion. We add what's called an EOM. It's called an emphasis of matter paragraph. Now, I will elaborate on that later on, but I want you to have this in your notes now. So when they do disclose the issues, we can give them an unqualified opinion, but we always add an extra paragraph called an emphasis of matter, EOM. And I'll elaborate on that a bit later as well. Here's the issue though, final point, I promise. The issue is if they don't disclose. So if there are going concern issues, but the business fails to disclose them, ladies and gentlemen, qualified opinion. We give them a qualified opinion in that case. So going concern actually has really severe implications on the audit opinion that we give. So a really quick recap. Number one, in the most extreme case, if they are not a going concern, it's highly probable they're not going to keep on operating. They have to prepare their financials under liquidation basis. If they don't, we give an adverse. Now that's the most extreme case. Doesn't really happen very often. What's more likely is if everything is okay and they're a going concern, everything is fine, we give an unqualified. If there are going concern issues, they need to disclose it. If they do, we can give them an unqualified, but we add the emphasis of matter. If they don't disclose, we qualify. And that's pretty much the summary of what happens. Now, I know it's going to take a little bit of time for you just to absorb that, but that's the really good summary slide that I can provide you. But again, I do urge you all to refer to ASA 570, 570, in particular the appendices, because in the appendix is actually a flow chart that helps you get to these conclusions as well, and I've provided it on your next slide. There you go. Now, I know that's small there, but once you actually refer to the standard, you'll have it in real life. So, as it says here, will the business continue to operate 12 months from the date of the auditor's report? That is basically the question of, are they a going concern, yes or no? Are there significant concerns, uncertainty, or issues regarding this assumption? If there are, have they disclosed them? Because the answer to that question will also impact on your audit opinion. And finally, in the most extreme case, has the report been prepared under liquidation basis? So please do refer to this because going concern is a really important area. Now, this one I'll be pretty quick with. When evaluating the results of the audit, we need to determine the following, guys. Have we collected sufficient, enough, appropriate, reliable audit evidence? Okay? We've gone through this a couple of times already. Does the audit evidence that we have collected, does it support the auditor's conclusions? right? Does it support our conclusion about whether the financials are true and fair? Okay? Does it support that? Have the working papers, has the testing results, has it all been reviewed? Has all the documentation been reviewed by the right people? Okay? And therefore, are we okay with the findings, and do the findings again link back to our conclusion? And finally, what we look at here, have all required disclosures, have they been made and are they appropriate? Remember, a misstatement is not just a number being wrong. It also can relate to disclosures that are required not being included. So it's really, that last one is really important. Okay. Now, say that we've done an audit and we have found misstatements. The question that we need to ask and have answered is, will these misstatements have an effect on the users of the financial report and the decision that they make? Ladies and gentlemen, what is that asking? It's asking, are those misstatements material? Because remember, it's only material misstatements that impact on our opinion. We can find a $2 error here, a $5 error here. That's not really going to make a difference. It's the material misstatements that are going to make an impact. Now, one more thing, ladies and gentlemen. Material means significant. It means will it impact on the user's decision based on that information? Okay? So remember, it all kind of comes back to that. And as I've been noting throughout today's lecture, a misstatement can be a number or it can be a disclosure that doesn't correspond with the accounting standards, all right? Please be mindful of that, because that's probably one of the biggest issues students often have. They're like, oh, no, but the number's right. Yes, but we don't just conclude about the statements, we're concluding about the notes as well, okay? So just be mindful of that. Now, one more thing. This is what students often have issues with as well. I want to be very clear here. What happens? We do the testing, we get our results, we identify misstatements. We communicate those misstatements to management. We communicate, we give them the opportunity to fix it. We give them that opportunity. We don't actually prepare the audit report. We don't determine our audit opinion until after those communications have happened. So please be mindful. We don't just find a misstatement and say, oh, qualified. We find a misstatement and say, hey guys, you need to adjust. This is wrong. If they adjust and the number is correct, we can still give a clean audit opinion. We can still give an unqualified. So please be mindful. There is quite a lot of communication and in some cases, negotiation that happens when it comes to misstatements. Okay? Because at the end of the day, we want the financials to be true and fair. So we do give them ample opportunity to make the required adjustments. And we do that before issuing the audit report and the opinion within that report. So please just be mindful of that. But again, as always, we can advise management on adjustments. We can advise management on what they need to disclose. We can't force them. So at the end of the day, it's on them, okay? It's on them. Now, as I said, communication. We communicate. When we do our audit, throughout the entire process we communicate, but in particular, we communicate at the end as well. Now, some matters that we communicate with the client include any irregularities that we have found, including fraud, including anything that's illegal, things like that. We communicate any significant deficiencies or weaknesses that we have identified in their internal control structure. So we've been doing all our internal controls testing, things like that. We found areas where it's not really working. We tell them. We say, hey guys, we've identified these deficiencies, these weaknesses. You probably want to look into those. What we also do in addition to that is we actually provide recommendations. We say, here are some ways that you could potentially improve on your controls. Again, question. Can we force them to take on our recommendations, yes or no? No. Okay? So just be mindful of that. We also communicate the results of our tests. So as I mentioned earlier, we tell them about misstatements. We tell them when things are not working. And this one's an interesting one. We also, when we communicate, we also set out any issues or disagreements we have had with them as well, because that can also happen. If you look at the example I've provided, sometimes there'll be issues in terms of the client thinks that they should depreciate using straight line method, but we think that they should depreciate using reducing balance method. So we do actually identify these disagreements as well. Now, how do we actually put all this together? Often in a management letter. not to be confused with a management representation letter. Remember, management representation letter is management to us. Management letter is from the auditor to management. And it's the letter that essentially sets out all of these things that we just discussed, including the recommendations on how they can improve their controls and their business and things like that. So we do actually put it all in a written document at the conclusion of the audit. Now, again, we cannot force them to do anything, right? We can provide them with the information, we can provide them with the advice, but ultimately it's up to them. Here's the thing though, we do have one thing up our sleeve. What is it? What is it? The audit report, the audit opinion. Because here's the thing, if we find a misstatement and it's material and we say, guys, you should correct this, you should adjust, and they don't, are the financials true and fair? Yes or no? No. And that impacts on the audit opinion. So we do have one thing up our sleeve, and that is the audit opinion and the audit report. So let's talk about that. Oh, we're almost there. Last topic. The audit report, now as I've mentioned here, it is a recap because we did discuss this actually in lecture 2. If you can remember lecture 2, remember lecture 2? We were so much younger. Oh, good times, good times. But anyway, it just shows how much we've grown. If any of you did the HSC in English, the journey we've come across. I know, that's the reaction I have as well, I'm sorry. So it's a recap. So remember, at the very end of the audit, ladies and gentlemen, the absolute output, the final task in the audit is to provide an audit opinion. And the audit opinion is in the audit report. Okay, so the opinion sits there and we provide the audit report, and that's at the very, very end of the audit. Now, before I go into the rest of the slides, and by the way, just a heads up, the rest of the slides are the same as what I showed you in week 2. So I have kept them consistent. But before I go into them, I'd rather just do a summary slide for you. All right, let's see how much of this you remember. We have discussed opinions here and there, but we haven't really focused on them after week 2. But we have 2 different types of audit reports, okay? All right, audit reports. We have 2 types. Does anyone know what they're called? Modified. Good, okay. Unmodified is the first one, and modified is the second one. Excellent. Okay. Now, please there's a reason I actually set out the notes in this way. These are audit reports, essentially the structure of the report, so to speak. They are not your opinions, okay? The opinion goes into the report. Now, given the report type, your opinions, you have a few options. So those were the audit reports. Then we have your audit opinions. If you are providing, or if you are issuing an unmodified audit report, ladies and gentlemen, the audit opinion that goes in that report is called unqualified or unmodified. You can actually use either term. It is interchangeable. We always use unqualified, but unmodified is also acceptable, all right? So either one. Now, with an unmodified report, that's it. You've only got that option. There's only the one, okay? And that is all covered under ASA 700. Now, before I go anywhere, the reason why, the only time, I should say, that you provide an unmodified audit report with an unqualified or unmodified opinion in it is if you think the financials are true and fair. Okay, you believe the financials are true and fair. What does that mean? There's no material misstatement. It's been prepared correctly, the numbers are reasonably correct, the disclosures that should have been included have been included. It's true and fair, okay? Any instance where it's not true and fair, you can't conclude that it's true and fair, will result in a modified audit report. And when you're looking at modifying the report, you have 3 options of opinions. The first, does anyone remember these? What are they? Qualified. Qualified, good.
Adverse and disclaimer.
Well done. Adverse and disclaimer of opinion. Now, first of all, ladies and gentlemen, the ASA dealing with modified audit reports is ASA 705. All right, so unmodified is 700. Yes?
Just quickly on an unmodified and modified portion. If you're giving an unqualified opinion with an emphasis of matter,
Yep. That's a really great question. Okay, so that one, back when I used to look into this, it would technically be called modified. Because you've added something to it, you've essentially modified the structure from what it actually was. So I would stick to that. Yeah, it would technically become a modified report. So if, that's really, okay, so what Josh just said is if we actually do have an unqualified opinion, but we add an emphasis of matter, which is what we discussed earlier and what I will remind you about soon, yes, that actually becomes a modified report structure because you've deviated from what an unmodified structure would be, okay? That will never come up in a question, all right? But you will need to know when to add an emphasis of matter. That you will need to know. Yes, ma'am?
So with the audit opinions, so is this correct that we can do unqualified or unmodified as a term?
Correct.
Not modified below?
Correct. Yes. So what Marlon just said is it okay? So you say it's okay to say unqualified or unmodified. They're interchangeable, so yes. But you can't say I'm going to give a modified opinion. There is no such thing as a modified opinion. It's a modified report, and within that you give either a qualified, adverse, or disclaimer of opinion. There's a reason I set it out in this way. There are two columns, okay? One of it is a structure, the other is the actual opinion name. Really good question. So please be mindful of that distinction. Now, one thing very quickly. As we noted, an unmodified report or an unqualified opinion, however way you want to think about it, we are giving that when we think the financial report is true and fair. No material misstatements and all the disclosures are there, all the numbers are there, right? Now, that's the one where they essentially look like this. That's the happy one, okay? As soon as you cannot conclude that it's true and fair, for whatever reason, and the reason could be because you know there are material misstatements, the reason could be because you couldn't gather sufficient appropriate audit evidence, whatever the reason leading you to not being able to conclude that it's true and fair, will result in a modified report. Now again, covered under ASA 705, but your opinions, your options, are qualified, adverse, and disclaimer. Qualified is the sad one. Qualified is the one where you're saying it's not true and fair. It's either because there are material misstatements or I couldn't get evidence, right? But the issue is contained within one area. I'm going to come back to that later. Adverse is the really, okay, I'm going to try to be creative here. That's adverse. Okay. Adverse is that one. That's the bad one because what you're saying with adverse is abort, abort, abort. Do not rely on this financial report at all. There are material misstatements everywhere, essentially. Okay, that's what we're saying with an adverse. So it's the worst one. Companies don't really come back from that too well. The final one is a disclaimer of opinion. Now, the best graphic I can use for this is literally a question mark. Because a disclaimer of opinion, ladies and gentlemen, is basically saying, I don't have an opinion. And the reason I don't have an opinion is because I wasn't able to gather evidence. And if I don't have evidence, I don't have anything to base an opinion on. That's what a disclaimer is. Now, students often ask me, okay, well, is that a good thing or a bad thing? It's a question mark. Because essentially, you don't know if the financial report is true and fair or not. Because you weren't able to do any testing. You weren't able to gather any evidence. As a result, you have nothing to base a conclusion on. So it's just a question mark. It kind of goes against the whole point of having an audit, yes.
When you were talking about qualified before, you
Yep.
said it was either material misstatements or they couldn't gather evidence. So do you mean that was in a certain...
Yes, and that's contained within a particular area. And I'm going to go through that in the table. Yes, yes. So disclaimer means you can't gather evidence on anything. Adverse means that there's material misstatements in multiple areas. And qualified means there's an issue, but it's contained. Okay, great question. Now, you need to know these. You need to know what each of these opinions mean. You also need to know if you're given a situation, which one of these opinions is the most appropriate response, given the facts of the case. Really important. Now, one more thing. You need to know your standards. You need to know your standards. There will be questions that ask you for your standards references and the paragraph reference. Yeah, okay? So you need, in particular, these ones. You'll notice that I haven't said that to you before. But you do need to know that, all right? So please make sure ASA 700, ASA 705, you need to print those out. You need to have them as part of your study notes, okay? So let's go through them in more detail. The first one is the unmodified audit report. Ladies and gentlemen, as we have noted, ASA 700 is your reference. You only provide an unmodified audit report if you are concluding that the financials are indeed true and fair. What does that mean? It means that they are free from material misstatements. It means that they have been prepared in accordance to the required financial reporting framework. Guys, the going concern thing. If they're a going concern, they've been prepared under going concern basis. If they're not a going concern, they've been recorded under liquidation basis. On that note, let me ask you a question, just to see if you understand the concepts. If a business is about to go, if a business has decided that 2 months after the end of the year, they're going to shut down. They're going to shut down their operations. Are they a going concern, yes or no? Yes or no, guys? No. Now, can they prepare their financial report under going concern basis, yes or no? What's the basis they have to prepare it on? Okay, here's my question. Good. Here's my question. If they do prepare it under liquidation basis and they prepare it correctly under the liquidation basis, can we give an unqualified opinion? Yes, good. Remember, you're not providing an opinion as to whether the business is good or bad. You're providing an opinion as to whether it's correct. Is it true and fair? Is it a true reflection of what has happened? Okay, please be mindful of that. Remember the misconceptions of audit we discussed in week 2, the audit expectations gap, right? We're not providing an opinion as to whether we think the business is successful or not. We're providing an opinion as to whether what's been included in these documents is true and fair, okay? So is it a fair representation of the business? Now, the structure of an unmodified audit report is as you see on the screen. So these are the different paragraphs and the structure that you will witness in an unmodified report. I've shown you this at the beginning of the semester, but the only key difference between this and what you'll find in your textbooks is the audit opinion is now at the top. So previously it was actually at the bottom. It's now at the top. We also have one additional section now called Key Audit Matters, and that's linked to ASA 701, which is a new standard that came through that requires auditors to actually provide more information. And I'll touch on that again later, but we have discussed that at the beginning of the semester. So the question then becomes, all right, if it's not true and fair, if we can't conclude that the financials are indeed true and fair, there's no material misstatements, we need to modify. We need to provide a modified report. So how do we know which opinion to provide? Here we go. First things first, again, ASA 705 is your reference. You need to print it, you need to have it in your notes. Now, this is probably one of the best reference slides to use for yourself in terms of what opinion you're concluding about. And there's essentially 2 questions that you should ask. Question number 1 is what you look at on the left-hand side. And the question is, why is the financials not true and fair? Why are you modifying your report? What's the reason? Is it because that the financial report is materially misstated, so you know there are material misstatements? Or are you modifying because you are unable to obtain sufficient appropriate evidence? Because they're 2 different things. The first one is you collected evidence and you know it's wrong. It's materially wrong. The second one is you weren't able to collect evidence. So that's the first question you should be asking. This is number 1. Now, based on your answer to that, the second question is, well, how severe is the issue? How much of it, how significant or how widespread is the issue? Widespread. Is the material misstatement contained in one area, like one account or one type of accounts? Or is it widespread and impacts on multiple different areas of the financial report? Now, the term I use widespread because it's easier than the term that we actually use, which is pervasive. Pervasive means widespread. And what pervasive means is the issue is present in multiple areas, okay? Multiple different areas. Now, why did I just mention the word different? Because if there is an issue with inventory, guys, this is really important. What people often get wrong here is they'll say, oh, there's an issue with inventory, but if inventory is wrong, COGS is wrong, it's pervasive. No, that's not pervasive, because as we know, an issue on one side of a journal is an issue on the other side, but that's still contained within that relationship. What's pervasive is when it's different areas, like there's an issue with advertising expense, inventory, sales, interest expense, accounts payable, different areas. So please be mindful of that distinction. You can't claim that it's pervasive if it's just impacting on the two accounts that are related. You can't say, oh, salary expense and salary payable are wrong, pervasive. No, because they're related. It makes sense that they're both wrong. Okay, so just be mindful, you want them to be different, multiple different locations being wrong. Anyway, so coming back here, if there is a situation, and I'll do this here, if there is a situation where the financials are materially misstated, but it's contained, which means it's not pervasive, you end up with a qualified opinion. So you literally go to the top, go to the side, find the opinion in the middle of the table that corresponds. So for example, in that case, we'll stick to inventory. We found that there was an issue with inventory. There was a material misstatement, but it was only in inventory and COGS. That's not pervasive, which results in a qualified opinion. However, if there were those material misstatements and it wasn't just inventory and COGS, but rather a multiple magnitude of other accounts, then you're sitting here, which is adverse. So you need to use this table and ask yourself those two key questions. Why am I modifying? Is it because the information is wrong or I didn't get evidence? Number two, how widespread is the problem? Is it contained or is it in multiple different locations, right? Now on that note, just with the inability to collect evidence, there's one thing I want to add here because I don't think I mentioned this at the beginning of semester. The reason why a reason why we are not able to collect evidence, guys, can be because the evidence was destroyed. So there was a fire or there was a flood or something like that and all the records were gone or the records of that particular account were gone. That's one reason. Here's another. You get to the audit, you get to the front door and the client says, yeah, I'm not letting you in. That's also that because you're unable to collect evidence. So it doesn't matter if the reason is a natural disaster or a fire or something. Another reason could be because they just did not give you access. That's also another way that you would still result in inability to obtain sufficient appropriate evidence. So just be mindful of that. Now again, if that happened, if you weren't able to get evidence, but it was only for a particular area, so it's contained, that's not pervasive. So you still provide a qualified opinion. But if you weren't able to collect any evidence on anything, that's when it's a disclaimer. That's when it becomes that question mark. Because remember, you can only come up with a conclusion if you have something to base the conclusion on. What is that? That's evidence. Okay? So use this. This is a really, really good slide for you to have as a reference point going into your exam. Are there any questions on that? Yes?
How many accounts need to be misstated to change qualified for adverse?
So, great question. So he said, how many accounts need to be misstated for you to go from qualified to adverse? As long as there's a multiple of different accounts, get to adverse. Yeah. Now, in saying that, I'm not going to give you a question where it's borderline. So I'm not going to get to a point where you have to exercise your professional judgment. It's going to be quite clear as to whether it's contained or whether it's not, but you need to know which one is which. Okay, good question. Anything else? Awesome. So the final thing that I want to mention in terms of our audit opinion is this. Now, guys, you have an audit opinion, but what auditors also have is an option to include an extra paragraph. Now, why would they exercise that option? There might be a situation where there's some piece of information the auditor thinks is really important and they want to highlight to the user. The way they highlight that piece of information is by including an extra paragraph. I need to say this again. It's an option. They don't have to. In the majority of cases, they don't. But there are certain situations where the auditor may wish to highlight a particular piece of information. Now, they can do so using two paragraphs. So there's two types. I'll say there's emphasis of matter. That's EOM, what I was talking to you about before. And the other one is called an other matter paragraph. Now, the distinction I want to make, first of all, is, well, which one do you use? Listen very carefully. An emphasis of matter paragraph is used if you're trying to highlight something, highlight information that's in the report already, right? The best example of that is this. We use an emphasis of matter if the business has uncertainties, they have going concern issues, and they've disclosed them, and everything else is okay, we would give them an unqualified audit opinion with an emphasis of matter. Why? Because going concern is so important. So we always want to highlight that. But because they've already included that information in the report, we highlight it using emphasis of matter. Guys, here's the key, the first word. Emphasis of matter you use when you are emphasizing something that's already there. An other matter is when you're highlighting an information that's other, that's not already in the report. Okay? So just be very mindful of that. Now, heads up, you're not going to get this. If anything, I just need you to focus on that and know when to use it. Instances where we do often see an emphasis of matter paragraph are these ones here. The key one is with going concern. Remember, you would only use an emphasis of matter paragraph if they have included the going concern issues. They've disclosed them already. And we'd link it with our unqualified opinion if everything else is okay. All right. Now, again, with this one, ASA 706 is the standard. So if you want to recap, ASA 700, ASA 705, and ASA 706 are your key ones in relation to audit reporting. Okay. Now, ASA 701 was the new one, and we did discuss this at the beginning of the semester. So there's only a few things I'll say here. The whole point of ASA 701, which, by the way, came into existence at the end of last year, the whole purpose behind it is it requires auditors to, I guess, disclose more information regarding what they've done in the audit. In particular, they're supposed to explain more information about how they did really tricky parts of the audit or where they exercised a lot of judgment. Now, why do we want that? Essentially, the key thing is to increase transparency. Increase transparency regarding how the audit is performed and how the auditors got to their conclusions, right? So users have a bit more clarity around the process and how they got to those final results. So essentially, it's increasing the accountability of the auditor, making the process more transparent, and providing more information to the users as to how the process actually took place. So that's really the only thing I want you to know about ASA 701, and I've provided an extract of that standard over the next 2 slides. So you can have a read of it, but that's basically it. They're called key audit matters. So anything that they wish to include and provide more information on, they're called key audit matters, KAM. Okay? So these are some extracts. You can have a read of them. All right, here we go. Ladies and gentlemen, I've got a couple of announcements for you. First of all, the key takeaways of today, there are 3 main areas I need you to focus on. Number 1, subsequent events. What's a subsequent event? What's our responsibilities in relation to subsequent events? What are the types of subsequent events, and what do we need to do in relation to them? Okay, very important. Number 2, going concern issues. Now, what needs to happen in relation to going concern? We need to make an assessment on whether they are or whether they're not. Remember, if there are going concern issues, they need to disclose them. And whether they do or whether they don't, ultimately everything impacts on our audit opinion. So it's a really, really important area that you need to look into. Make sure you're okay with. The third one, audit opinions. Okay, as we just discussed, you need to be able to understand what each opinion means and when you would provide which one, given the facts of the scenario. Okay, so please focus in particular on these 3. You'll notice I spent a bit more time on those throughout the course of today's lecture. Today's lecture is really important because it's actually going to be have a big presence in your final exam as well. Because remember, it's the end. So everything kind of gets to this point, okay? And on that note, congratulations. You've now learnt the whole audit process, hopefully, from the beginning to the end. Now, on that note, guys, just give me 1 more minute. Really what needs to happen now is practice and revision. So on that note, next week there is a revision lecture. However, I'm not teaching you audit next week. I'm just going to be revising a couple of the key things that I think you should pay extra attention to. I will tell you a little bit more about your final exam. But please note, it's not recorded. So next week is not recorded. I'm actually not sure about the slides yet either. So you might get them or you might just come in. I'll make an announcement about it soon. But next week is our final class. Guys, when I say final class, final lecture and your final tutorial. So this week is your catch-up tutorials. Remember, next week is your final class. We go back to normal. The structure's back to normal. So you start with your quiz, you do your presentations, and we have our final in-class activity next week on this topic. Okay? So you're almost there. You're almost there. Have a fantastic afternoon. I will see you all next week. Good job.